Hello, everyone. Welcome to today's session on ESG environment clarity for a sustainable tax function. Thanks so much for joining us today. My name is Scott Sunday with Vertex, and I'll be your host and your moderator. Before we get started, just a bit of general housekeeping to review with everyone. First, I'd like to ask everyone to please keep your audio muted to avoid background noise. On your presentation console, the Q&A button will allow you to submit questions. Feel free to post any questions here, and we'll get to them during the Q&A portion after the presentation. The resource list on your console contains additional information about ESG. For information and registration for the annual Vertex Exchange 2023 conference, just click the link in the Resources tab. After the webinar, you'll see a short survey appear on the screen, and your feedback is very valuable to us for future webinars. So I'd like to encourage everyone to please answer the survey. We're actually going to be doing a gift card drawing. So we're going to be giving away 3 $50 gift cards for people who complete the survey. So just like I said, please keep an eye out for that. It'll appear on your screen as soon as we finish the presentation today. If you'd like to speak to anyone from Vertex, just click on the Request Demo button on your console and just follow the form instructions. And then lastly, a link to access the recording of today's presentation will be available in coming days and emailed to everyone that registered. So today's session is accredited for 1 CPE credited. Vertex is registered with the National Association of State Boards of Accountancy as a sponsor of continuing professional education on the National Registry of CPE sponsors. So I'm showing the learning objectives on the screen here. To obtain the CPE credit, you must remain on the live webinar for a minimum of 50 minutes and answer the 3 poll questions which will appear throughout the presentation. You can submit your answers by clicking the response options on screen when the polls appear. You'll see an Apple CPE icon on your attendee console. After you completed the CPE requirements, just click the Apple icon, and from there you'll be able to view and print your certificate. Okay, so let's go ahead and get started. I'm super pleased to introduce our presenters today. Chris Walsh, Vertex Director of Tax Innovation. Linda Bonelli, Deloitte LLP Partner. Zoe Hawes, Deloitte Indirect Tax Director, and Frank Falvo, Deloitte LLP Project Managing Director. Thank you guys so much for joining us today. So before we get started with the discussion, just going to show the agenda today, what we're planning on covering, and we're about to jump into our first poll question. So we're going to cover tax and sustainability, a little bit about it. We're going to talk about policy developments, and then we're going to get into implications for the tax team. But before we get into that, like I said, let's do our first poll question and find out which areas of ESG are most relevant to your organization. Is it renewable energy, compliance and regulatory obligations, ethical supply chains, accountability, investor pressure, business transformation, tax incentives, tax transparency and reporting, or other? So we'll give everyone a few minutes, a few seconds to put your answers in. And while you're doing that, Chris, I wondered if you could just tell us briefly, in your opinion, what kind of trends you're seeing in the industry in terms of this.
Yes, certainly. And hello, everybody. I think most of the conversations that we've been having with potential clients and those that are struggling with the challenges of ESG have really been primarily focused on risk management at this point in time. I think what we're seeing is a transition from the sort of reporting and tax requirements that are being put out by different countries. They're transitioning from being optional to being mandatory, and the speed at which this is growing is pretty unprecedented. So a lot of tax directors are looking around the world saying there are these hundreds of pieces of legislation popping up all over the place requiring me to account for taxes here and do certain reporting there. I just can't keep track of it all. I'm not sure what my compliance position actually is. And so that brings the whole risk management discussion into play. And so I think that's where companies seem to be struggling the most, certainly from the discussions that we've been having, just getting their arms around where do companies sit in this this rapidly evolving global ESG environment.
Great. Thank you, Chris. That sounds good. Okay, so let's go over and see what everyone said. Let's look at the poll results. Okay, so it looks like most people said tax incentives. 33% said tax incentives, 20% tax transparency and reporting, and 20% on compliance and regulatory. Very interesting.
Yeah, I think that probably does reflect the fact that different parts of the world are moving at different speeds as far as ESG is concerned. So if you look at Europe, for example, they're very well advanced in terms of taxation of plastics and shopping bags and all sorts of different things, whereas here in the US we're not quite at the same level. So incentives may be a bigger issue or a more important topic here in the States than it might be in Europe.
Great. Chris, I'm going to turn it over to you. I'm going to move into the next slide. So
sure.
Handing it off to you.
Thank you. So as far as this slide is concerned, I know a lot of the discussions that we've been having with users of our software in this area have really been focused on, have started out at least with, well, what is ESG? I think most of us have heard of ESG. You've seen it in the press, but it's a relatively new terminology. The contents of it are not that new. But what we're trying to do here on this slide is just to illustrate, what sort of measures fall under E, S, and G. And I also included in here the first E, the economic box, because this is the information that we traditionally are used to reporting. So if you look at any company's 10K or annual report from the last however many years, this is the sort of information that you will see on it. It's about economic and financial performance. But ESG is moving the reporting side of this away from financial performance into other areas. So ESG stands for environmental, social, and governance. And what I've done here is I've put under each of those headings a few examples of the sorts of things that you might see as regulatory measures falling under each of these. So I think one of the things that we're all very well aware of is carbon emissions taxes. They've been around for a long time. Carbon emissions reporting, carbon trading, all that sort of stuff. It's been going on for a long time, and that clearly falls under the environmental heading, along with water pollution taxes, air pollution taxes, landfill taxes. An awful lot of what falls under environmental are by their nature taxes. And so you end up with a much bigger compliance burden as far as environmental measures are concerned. Social and governance are somewhat different. You'll see here, and you will come across in your daily lives statements about modern slavery and inclusion and diversity and all these sorts of things. These fall under the heading of social. And again, these are measures that are moving from the optional to the mandatory. But when it comes to doing your annual report, you will increasingly see requirements for companies to report on their performance against their social targets and their governance targets. So there's a whole new set of reporting coming into play here, where you're setting targets and tracking performance against those targets. As far as targets are concerned, under the environmental heading, of course, we've all heard of the net zero target. but there are lots of others that fall under the heading of social and governance as well. So that, I hope, will give you a very high level 30,000 foot view of what is ESG. It's a very wide ranging collection of requirements that are not, they don't necessarily sit together very naturally, but let's say they represent a new level and the new areas of both reporting and taxation. With that, let me pass it over to Zoe for her to tell us a little bit about what does this mean for tax departments.
Great, thanks, Chris. So there's a number of ESG and tax touch points. Perhaps the most obvious is around those environmental taxes and incentives, which we'll cover a few examples shortly. So just 3 other examples that I'd call out around transparency and governance, supply chains, and reward and mobility. So tax governance and transparency, that's been part of the G of ESG for some time. It's already a core metric in some of those broader ESG frameworks. We're seeing regulators, though, placing increasing transparency requirements on businesses. So, for example, EU country-by-country reporting, and Australia and other countries looking at similar regimes. And other stakeholders as well, such as investors, take tax into account. Supply chains, I think about new products or new markets, changes to sourcing, those will all have indirect tax consequences that will need to be anticipated and managed. So I think that's a good example of ESG increasingly becoming a driver of business as usual tax operations that need to be taken into account. And then rewards and mobility, a range of considerations here, things like executive remuneration packages and the alignment to ESG goals of the business, seeing a growth in electric vehicle salary sacrifice schemes, and also fair pay and the gender pay gap continue to be areas of focus. So as ESG drives business change, there will be a number of operational implications for tax teams to manage. I think now we're going back to Scott for the next poll question.
Yep, thank you, Zoe and Chris. Sounds great. So yeah, we're going to get into our second poll before we get into the exploring policy development section. So here comes the second poll. So is everyone familiar with various state and federal environmental taxes? Yes, you're familiar and the impact on your business. Yes, I'm familiar with these, but have yet to consider the impact. Yes, I'm somewhat familiar. No, I'm not familiar with these and the impact on my business, or not applicable. So we'll give everyone a couple more seconds to put their answers in. And we'll get over into the results. So let's see what everyone said. Coming up in a second here. Okay. Yeah, Zoe and Chris, Linda and Frank, these are the results. So curious what you think. Looks like most folks are somewhat familiar or not familiar.
Yes, I think this reflects the fact that ESG. We talk about ESG being a singular topic, but actually it's made up of many different parts. And so my expectation would be that some people know some of it or are familiar with some of it, and other people are familiar with other pieces. As I mentioned previously, there are tax aspects to ESG, and there are reporting aspects connected with ESG. And as was also mentioned, there are incentive possibilities as well. So, different teams may have a view on those. That you would expect the tax team to be dealing with the tax aspects of it. You might expect someone like risk management or corporate affairs or someone like that might be, or even a sustainability team many companies now have sustainability teams to be responsible for the reporting aspect. So it's one of those things that's a very tricky area to actually for any one team to get their arms around. So I can see why people would think that they may not know as much as they really do know about ESG.
Mm-hmm. Mm-hmm. Yeah, that's great insight, Chris. Thank you. So I think now we're going to kick it over to Frank. So curious, Frank, as we get started in your section, like, are there any particular United States environmental taxes that are top priority for your clients?
Yeah, there sure are, Scott. That's a softball question because over the past year, just about the past year, there have been a couple of new taxes that have been implemented in the United States, and we generally call these the Superfund excise tax. So, I think Chris was mentioning, there's taxes and there's incentives. Clearly, the taxes are the stick, and the incentives are the carrot for ESG matters. So, the first tax that one of the first taxes that became effective last July 1st of 2022, is an excise tax that was part of the infrastructure bill. And this is referred to as the Superfund excise tax on hazardous chemicals. So this tax originally existed from about the mid 80s to the mid 90s, at which point it expired. But it was resurrected as part of the infrastructure bill. And it's in existence for the next 10 years. And it's a tax on hazardous chemicals that have been specifically identified in the legislation. So there's a list of 42 chemicals. And if a company is either importing or manufacturing one of these chemicals in the United States, then it's liable to report and pay the excise tax. The tax also applies to a specific list of what have been identified as imported taxable substances. So if a company is importing one of these listed substances, then that company is liable to report and pay the tax. So although the liability is on the manufacturer or importer of the tax, these companies, what we are seeing, are passing this tax along to their customers. So it's ending up in the supply chain. So even though a company may not have direct responsibility for it, they are certainly bearing the economic burden of this tax, we're finding. The other tax, which is also, it's a petroleum tax, which became effective as part of the Inflation Reduction Act, is a Superfund excise tax on crude oil or imported petroleum products. So again, this was a tax that was originally in existence in the 80s and 90s, at which time it expired, but was resurrected as part of the IRA. And this is a tax, a per barrel tax that is imposed on crude oil. So it definitely hits our domestic crude production, and on petroleum products, which has a very broad definition on petroleum products that are imported into the United States. So again, this tax is in existence for the next 9 years, and it as well, we're finding the economic burden of the tax is being passed on in the supply chain. The other tax that impacts a lot of different industries is the ozone depleting chemicals tax. This tax has been around since the 1980s, and it's a tax that's imposed on specific chemicals that have been identified as causing depletion to the ozone layer. And it applies to these chemicals that are produced in the United States or imported into the United States, but also on products that are imported into the United States that may contain these one of these listed chemicals, or that were produced by one of these chemicals. Again, this is an excise tax, and it's reported quarterly on an excise tax return. So with that, since I described a few of the sticks that are used for ESG, turn it over to Linda, who can discuss one of the carrots or more, the carrots in form of incentives.
Perfect. Thanks, Frank. So as Frank said, we are looking at kind of a stick and a carrot environment these days. The great news is that we are hearing more and more carrots coming online. So one of the things I'm sure most of you in the US have heard of some of the great benefits under the Inflation Reduction Act or the IRA. And there's really a number of areas. We like to kind of bucketize it, if you will, at Deloitte to kind of make sure that we're looking at it, holistically and making sure that we're covering everything that's in there. So the legislation is significant. It's 725 pages or so, addressing various categories. And if you kind of put it into some buckets, it's easier to remember and kind of comprehend it and see where it fits best into your organization. And it could be all. So one would be manufacturing. Another is transportation and fuel. Another one is hydrogen and carbon capture, and then renewable energy. So if you kind of think through those 4 areas, that is really where this legislation is focused. And what is great about the IRA that we really haven't seen in the past is when you have an incentive, it's typically for an activity, and it's typically going to be what you're doing, what you're producing, et cetera. However, this legislation has made it so broad that it is the entire supply chain. So when you're looking at renewable energy, for example, it includes the entire supply chain. So it's not just a solar panel, but it's all components of the solar panel. So there is a number of different areas where organizations are fitting what they're doing into this legislation and availing themselves of the benefits. One of the other things that is really a huge carrot from the legislation is that this is now available to be transferred. So there's a direct pay and a transferability option on a number of the credits under the IRA. And transferability means that you are able to transfer it at one time, transfer it to another party. So there's a lot of discussions going on around how you would transfer this. Is there going to be indemnification? Do you need insurance? So there's a lot to be kind of worked out as you're looking at transferability. But the great idea that they came up with is providing significant benefits to entice taxpayers to do things like, transform your business to a greener, new approach. And a lot of times that's going to be a significant capital investment. Having depreciation, maybe having startup costs, et cetera, may not put you in a taxable position. So being able to monetize these credits is something that we haven't seen in the past from the federal government. And so the concept is fantastic. The other area that's really kind of new and innovative for the federal government is the direct pay. So that makes this entire legislation, it makes it applicable to non-for-profits. It makes it applicable to areas where we would not have necessarily talked about tax credits because they're historically not in a taxable position, or, like that non-for-profit, not a taxpayer. So having these carrots put out there and really exploiting every opportunity to bring benefits to clients and bring benefits to taxpayers across the states is really a new and innovative approach. We are seeing this globally, where the EU, as Chris had mentioned, some countries and some jurisdictions are further advanced than others. The EU has always had the Green Deal. not always, but has had it in place for a number of years. And their entire program is really focused around more cash grants. With the IRA, we do have significant funding for grants. The Department of Energy, the Department of Labor, the Department of Transportation, all these various agencies have received significant funding from the IRA. And they are continuing to work through how to allocate that money out. The other thing that we're seeing is, countries like Canada, who saw what the US did, and they have almost mirrored directly what the US has in the IRA, and have very similar legislation that was just released. So these carrots are becoming more and more common, and we're seeing them across the globe. And it's just a fantastic way to really help organizations support changing their current environment to a much more sustainable environment. The one last thing I would like to say is, as Chris mentioned, there's a number of different aspects in ESG. And, from a tax perspective, there's even incentives from the social side that a lot of times in the past we might not have paid as much attention to. For example, the labor standards, or some of your DEI transformation that you may be going through, there could be incentives in those areas as well. There's significant training grants at the state and local level. Credits like WOTC, which is a work opportunity tax credit, provides you a federal tax credit for hiring certain individuals. Well, those individuals are really going to help your social impact, and being able to track that and being able to show that you're training individuals, that you're have a diverse employment group, and that you are continuing to focus on bringing up an education standard for all your employees. These are all very important aspects, and there's typically incentives, if not at the federal level, at the state and local level, that you can associate with those activities as well. So I think we probably want to move on in the interest of time. And I think we're turning it back to Zoe to kind of talk through some other aspects that we're seeing.
Yeah,
Yep.
So go on.
Over to you, Zoe.
Back to Europe then, to look at a couple of key developments that a number of businesses are focused on. So first around plastics and the regulation there, and second on the EU carbon border adjustment mechanism. So on plastics, then the scale of pollution here has grown significantly recently. So by some estimates, there will be more plastic in the ocean than there are fish by 2050. And we're seeing a wave of different developments in response to that. This can be voluntary commitments, also seeing the UN Global Treaty for Plastics, and also regulation. And I wanted to cover two regulatory developments in this space in a bit more detail. So plastic packaging tax, and then extended producer responsibility. On plastic packaging tax, both the UK and Spain have recently introduced new taxes. UK was 2022, so last year, and Spain from the start of this year. And they've perhaps brought environmental taxes mainstream for the first time. They're designed to change behaviour, increase the use of recycled plastic in packaging, and they do that by taxing the non-recycled plastic content in that packaging. The mechanics of the taxes are quite different between the UK and Spain, but we're seeing in practice there's some similar underlying data requirements that businesses operating in both territories will need to consider. And the rate of tax is currently £210.82 per tonne in the UK, and in Spain, €450 per tonne. So again, a bit of a difference you can see straight away, just in terms of the rate of tax that applies. And one of the challenges that business has been facing is the administrative burden and getting hold of that data to support the compliance and reporting. And we'll come on to that in a bit more detail later. The other topic was extended producer responsibility schemes. And these have been in place for a number of years. The OECD has counted that there may be around 400 in operation, and they tend to cover several different products. So packaging is one, but can also be other materials like textiles. And these schemes aim to make producers responsible for the environmental impacts of their products all the way through the supply chain, from that initial design phase to the post-consumer phase. So again, just calling out a couple of examples. Hungary introduced an EPR very recently at the start of July. That covers packaging and again, a number of other materials. And that fee is imposed on producers and importers of those goods and can apply where there's those goods being used to provide services. But a measure that's common in a number of EU countries. So switching to one of the examples that Chris mentioned at the start in terms of energy and emissions taxes. And here, this is a new measure that's part of the EU's Fit for 55 package to help achieve its net zero ambitions. So the carbon border adjustment mechanism is designed to address carbon leakage, where there's emissions intensive manufacturing activity offshore with the resulting products then brought into the EU. I think there's probably three key things to know in terms of what's covered, who's responsible, and when does it come into effect. So what's covered in terms of the products, it's a limited range of products to start with, including cement, electricity, fertilizers, iron and steel, aluminium, and hydrogen. But other goods may be added over time. And in terms of the embedded emissions that are covered, that's carbon dioxide, and then depending on the product, there may be some other greenhouse gases that are caught. Who's responsible? It will be the importer of those products into the EU. Non-EU established companies will need to think about representation requirements, and then access to the registry and meeting the various requirements will be for the authorised CBAM declarant once it goes live. And the third, in terms of when does this come into effect, the transitional period starts on the 1st of October this year. And during that period, there are reporting requirements that need to be met. So details like the quantity of each type of good that's imported, the installation that manufactured those goods in the country of origin, and embedded emissions, and any carbon price that has been paid. And the first of those reports will be due in January 2024. And then when the full implementation comes in, that's expected from 1st of January 2026. There'll be annual CBAM declarations when CBAM certificates need to be surrendered. And those CBAM certificates need to cover the emissions produced, and the price will be linked to the average emissions allowance price under the EU ETS. And those CBAM certificates will be phased in gradually as the EU ETS free allowance allocation are phased out. So that sort of cost will be introduced over time. So that's the what, the who, and the when of CBAM, just as a high-level overview. But turn back now to Scott for our next section.
Thanks, Zoe. That was terrific. So before we get into the implications for the tax team, I wanted to go ahead and do our third and final poll question of the day. So who's responsible at your organization for managing global environmental taxes? Is it the central tax team, local tax teams? Is it legal or regulatory compliance, commercial and operations? Maybe a mix of teams with governance and accountability, a mix of teams with limited governance and accountability, or not applicable. So, as we're as you guys are putting your answers in, just going to give it back over to Chris and just ask, while people are answering, Chris, what's your experience of how companies manage these kinds of responsibilities? And we'll go into the results in just a minute.
Yeah, I think what we've been seeing mostly is confusion in this area. We're starting to see some of the very largest companies establish sustainability teams, or even ESG teams, but they tend to be more focused on policy and setting targets and those sorts of things, rather than the operational matters. But as I'm sure our attendees will appreciate, there are dozens of countries implementing this legislation. Each country, you can probably say on average so far have implemented maybe 10 pieces of legislation so far. So, when you multiply it all up, there is an absolute forest of legislation either out there or on the way. And just navigating all of that has been extremely difficult. So what we're finding is that a lot of responsibility is being pushed down to regional level, just simply because they're closer to the issue. But what we are finding almost exclusively, even with the very biggest companies, is that virtually all of the tax compliance side of this is being run manually. So if anyone listening is sitting there thinking, we're way behind, we're doing this all on Excel spreadsheets, you're not alone at all. This is really, one of the big challenges at the moment is to actually find a better way of dealing with risk and compliance in the ESG area.
That's great, Chris. Thank you. So let's see what everyone said for their answers to this. Wow, okay. Kind of a mixed response. Looks like most folks answered it was a mix of teams with clear governance or limited governance and accountability. So,
yeah, I think what I would expect to see is, the tax teams will be dealing with the tax aspects, and other teams will be dealing with the reporting, and maybe even other teams again will be dealing with the incentives. So I haven't come across any company so far that has a single team that does all of this.
Thanks, Chris.
I
Linda,
would agree. Yeah, I would agree with that. And I do think the area where we're seeing legal and regulatory compliance, I do see a lot of that being kind of bubbled up to the front. Government affairs is typically an area where they are in the forefront of some of the regulations that are being discussed, even before they are made public, and they have the ability to influence how some of those regulations are going to be worded, and how restrictive they're going to be, or if there's going to be opportunities for organizations to be able to have extra time to meet some of the requirements and become compliant. So I think government affairs is really in the forefront of managing. Now, in the overall organization, they may not be connecting with everyone. They may not be connecting with the local teams as much, or they may not be connecting with tax. But I think that's a challenge. And Chris, as you're pointing out, no one's really got the perfect case scenario down yet. But I think what organizations are starting to recognize and acknowledge that they do need a working group with a number of these functions included, and a number of people doing their part and connecting all the dots, so that that's the best way for your organization to have influence prior to something being regulated. And it also gives you the ability to take advantage of incentives and be maybe tweaking some of your activities to make sure that these benefits, grants and tax credits are available to your organization. So that's kind of what we're starting to see as a trend, at least in most of the US companies that we're working with.
Yeah, I think that's absolutely right. And in the meantime, it also presents a challenge for advisors like Deloitte and technology providers like Vertex, in that finding the right people to talk to is a challenge in and of itself, because you're having to try and round up quite a disparate group of folks to actually have that conversation. So yeah, it's a challenge all round.
Exactly.
Thanks, Chris. Thank you, Linda. So I guess we can roll over into our rest of the last section here and talk a little bit about, given these different challenges, the compliance challenges, if there was a solution that existed that could help organizations to mitigate this, let's talk a little bit about what that could look like. So turn it back over to Chris.
Okay, thanks. So, when you're thinking, obviously Vertex, is a tax technology company. And so, we've been turning our thoughts to, well, how can we help companies get away from the Excel spreadsheets and into something a bit more automated and improve and streamline the processes. So this is just really a sort of a high-level view of what a solution might look like. What is it you really need to know to be compliant? And I think we've sort of boiled it down to four aspects, or four topics, I suppose. First of all, you need a watch list. The biggest single issue, as I've already mentioned, is just the rapidity of the growth of ESG legislation around the world. You've got to find a way of keeping track of what's coming your way and what's going to impact you, because not all of these pieces of legislation are going to impact you. I mean, if you're a financial services organization, for example, you're probably not going to be impacted by air passenger duty, which is charged on airline tickets, or landfill taxes, or those sorts of things. So you've got to be able to pick out the wheat from the chaff, if you like. So a watch list is important, and sourcing that information is a challenge. The second thing is what we call law summaries, which is really understanding what those laws actually say. It's not the most difficult thing in the world to put together a watch list, but to actually understand what the laws are saying. I mean, obviously they can be written in foreign languages. The terminology and jargon may be quite different from what you're used to. So actually interpreting the legislation that you're reading is important, because it's only once you've got the watch list and the law summary that you're really in a position to figure out, well, what's impacting me, and therefore what should I prioritize? Because what you don't want to do is end up trying to grapple with thousands of pieces of legislation from all over the world in a multitude of different languages. You need to be able to try and cut through that. The next piece is, obviously there is particularly in the environmental area, there are a lot of taxes. So you need to be able to calculate those taxes. So you need to understand what are the rules, what are the exclusions and exemptions. I think Zoe mentioned earlier that the plastic packaging tax in the UK is £210 per metric ton. But there are exceptions and exclusions for recycled plastic. So there are all sorts of different aspects that need to be built into a tax calculation. And then finally, of course, reporting. Wherever you have a tax return that you've got to fill in, you've got to be able to submit it. The other aspect of reporting, of course, is the much broader aspect of providing the right information and data for your 10K and your annual report, which is all becoming necessary. So having some sort of reporting engine is, again, another vital aspect of this. So if you're looking at, building some form of technology or process around ESG. I think these are probably the four core elements that you would need to think about.
That's great, Chris. Thank you so much. Just moving into our next section here, Chris, just wanted to ask. I guess this question would be for Zoe. So, given the complex landscape, how are tax teams responding to all of these challenges? Can you tell us a little bit about that, Zoe?
So I think we've covered a lot already as we've gone through, but I think I'd bring that together in terms of starting with understanding what the business ESG strategy is and where the key changes are going to be, then overlaying the tax policy developments, and then finally considering what that means for the tax operating model. So on those business changes, then we're seeing business partnering becoming more important, often with new stakeholders, as Chris mentioned, sustainability teams and that wider role. And I also think we're seeing in larger organizations some of the appointment in the tax leadership team of somebody with responsibility for environmental taxes. On that developing legislation front, I'd echo Chris's comments around that being often one of the first questions we're asked, just around what are some of the changes to existing measures, but also how can we track what's coming down the line, not just to ensure compliance, but to ensure feeding into consultation processes, thinking about how new taxes might affect investment decisions or be fed into projects such as ERP implementations. And then on that final piece around the operations, I think that's sort of putting a climate lens or ESG lens on the tax operating model. So what are some of the changes in terms of the data systems, processes, those roles and responsibilities, as we've said, both within tax, but also outside of tax. And then where do some of the costs for this sit commercially, whether that's a cost in the supply chain, something that the organization bears, or actually is it something that's going to be passed on in the pricing, and do the contracts enable that? So starting with the business, but then laying the tax developments onto that to then manage that through the operating model. But Chris, I guess, is that similar to what you're seeing in practice as well in terms of that response?
Yeah, I think that's exactly right. Yeah, and actually, the question of pricing and contracts comes up regularly as well. I think tax teams are being asked, if we incur these taxes, can we pass them on to our customers, or do our contracts already state tax inclusive pricing? In which case, we're just going to have to eat it. So there are a lot of practical issues involved in this. And as I say, just a lot of confusion as to who should be taking responsibility. But I think it is important to note that some of the largest companies are now taking up ESG at the board level. You're seeing VPs of sustainability being appointed and so on. So particularly amongst the big multinationals, I think we're starting to see quite a serious uptake on advisory in this. But it's, as I say, while the responses are somewhat fragmented, it presents something of a challenge for all of us to advise companies in that way.
Thanks, Chris. So, I mean, in terms of the responsibility at organizations, I mean, who typically takes on the responsibility in your perspective at the organization for these measures? And I guess that would be for Linda or for Chris. What do you guys think about that?
I would say, as far as responsibility is concerned, we're mostly, again, Vertex being Vertex, we're most interested in the tax side of things. And we are finding that just because these environmental taxes have the word tax in them, they are being shuffled towards the tax teams. And I think a lot of the tax teams are feeling a bit put upon with this approach, because they are not experts in these taxes. They don't have any specialization in landfill tax or plastic packaging tax or whatever it might be. And so they're not really necessarily in any better position to deal with them than anybody else in the organization. So, but we do tend to see the tax piece going to the tax teams, possibly the finance teams helping out as well. As far as the reporting is concerned, though, that could be anywhere in the organization.
I would agree with that, Chris. And I think we are seeing, as you mentioned earlier, we are seeing more and more organizations, especially multinationals, that are specifically naming a VP or a chief sustainability officer, and making kind of a department that pulls everything together and has that responsibility. So I think a lot of organizations right now are still splitting responsibility, as you were saying, Chris, but I also am seeing more and more what you said earlier about a chief sustainability officer position being created. And it is something that is more and more common at the board level. And because of that, we are seeing a focus to have a officer level individual be responsible.
Yeah, and actually, if I could just a thought for everybody, and I'm not talking out of school here, but one of the examples that we've focused on recently, and as I say, I'm not talking out of school because it's in the public domain, is if you go on to if you're curious about what does reporting look like in the ESG world, take a look at some large multinational companies' annual reports. One of the ones that we've focused on more recently, and I'm sure they won't mind my mentioning them, is Diageo, the very large multinational drinks company. If you go onto their webpage and just go to their annual report for last year, you'll see that their annual report runs about 120 pages, of which 30 pages are ESG reporting. So not only does it give you a really good example of what ESG reporting looks like and what sort of data is being reported, but I think it also suggests to you what an investment ESG is, because something that we shouldn't forget is that all this ESG reporting and so on is auditable. So I think maybe next year or the year after, when it comes to talking with your external auditors about, what's to be audited, the scope and pricing of the audit, you could very well see a lot of ESG type information falling within the scope of the audit, and that, of course, will increase the price of the audit. So it's something to look out for. I did hear, I was recently on a 3-month secondment over to the UK. And I was hearing while I was over there that ESG reporting could raise the cost of an audit by between 20 and 30%. So, this is no small thing. The final thing I would mention about ESG is that there are a lot of companies out there that are scoring companies as far as ESG is concerned. And these are particularly the rating agencies, Standard & Poor's, Moody's, these sorts of companies. They're allocating ESG scores to companies. And that's important because that acts as an investment criteria for a lot of pension funds and investment funds of various sorts. So they're saying if you don't have an ESG score of at least X, then we're not going to buy your shares. We're not going to invest in you. So this is another important aspect of really addressing ESG as a C-suite level issue, because, as I say, it's going to impact investment in your companies.
Thanks, Chris. So I know we're getting towards the top of the hour and want to make sure we have a little bit of time left for any Q&A or questions that the audience may want to submit. So just want to remind everyone, if you do have a question, please go ahead and submit that using the Q&A button on your audience console. So I do see some questions coming in. One question, this is a good question. How are companies managing the new Superfund requirements? Frank, would you be able to speak to that a bit?
Yeah, sure. And that is a great question. And it's almost across, it's over the board, it's across the board. There have been a number of companies that, this was not a huge burden for them because they did not have a lot of products that were necessarily subject to the excise tax. However, a large number of our clients and some of the really large chemical companies, and oil companies, and some others that are subject to the Superfund tax had a great deal of need to obtain the necessary data to properly report, calculate, to identify the taxable products, to quantify the tax, and to properly report it. So in addition to trying to gather the data, it was really important for them to be able to have their processes and their systems in place in order to gather that necessary information. And oftentimes the tax department had to go to the business operations and speak with the specialists who understand these products. And these are, could be very, sophisticated products that a tax department would not necessarily be able to identify on their own. So they had to deal with, the business operations. They had to have the necessary data, and they needed to have their processes in place. And a lot of them had to have new updates to their SAP and their accounting systems to be able to capture this information. So that was one of the largest issues that companies had. And then aside from that, even if companies are not liable for the tax, to report the tax themselves, as I mentioned earlier, the companies that are liable for the tax are almost in every case passing the economic burden of that tax on to their customers. And there are opportunities and there are some opportunities for those customers to recapture or to recover excise tax on some exempt uses, particularly if they're paying tax and then export the product. And the IRS hasn't come out with a great deal of guidance at this point. So there's a great deal of challenge that companies are having to be able to claim refunds or credits on taxes that they've paid. So we're dealing with that quite a bit at this point.
Excellent. Thank you, Frank. So a lot of questions coming in. I think we're only going to have time for one more. So question is, this might be for Linda. What are some of the key compliance and operational considerations that you're seeing?
So from a compliance side, we're seeing, we're not seeing a ton of activity as of yet, because at least from the IRA, I should say, because that is still relatively new. So the IRA really started it was passed last year, August, and then most of the credits and benefits started in January. So people are now just getting funds, whether it's, grants, whether it's credits. A lot of credits are not going to be reported until, they're putting investments in place now. You're looking to make sure you're eligible, you're getting your documentation and support in place. And then you're going to be filing it with your tax return, which is going to be, probably next fall. So we're not seeing a lot of compliance starting yet, but people are starting to get ready for the compliance and making sure when you're doing projects, if you're, for example, if you're looking for an ITC and you are getting the multipliers, which are showing that the wage requirements and the apprenticeship requirements are met, they're having discussions now and getting support and documentations from their vendors to make sure that those requirements are met so that they get multipliers and then they'll have that in their file for when the tax credit is audited in probably, 4 years or so. So it's still in process, and people are starting to work through the compliance and getting the support right now.
Great. Thank you, Linda. All right. Well, thank you, everyone, for this amazing presentation. That's about all that we have time for today. So just to wrap it up, as a reminder, anyone that's interested in obtaining the CPE credit, you should just be able to click the Apple icon on your console on the Resources tab. Provided that you've met the CPE requirements, you should be able to print and view your certificates. One more thing, just like I mentioned at the top of the call, we're going to have a survey that appears on the screen as soon as we close the webinar, just to get your feedback on today. We're going to be doing a random drawing. We're going to give out 3 $50 gift cards to people who complete the survey. So definitely do that. We'd love to get your feedback. And if anyone has additional questions or question about Vertex or any of our best-in-class solutions, we'd love to connect with you. So just click on the call to action or demo button in the console, and someone will be in touch with you. So really appreciate everyone's time attending today. Thank you so much. We look forward to seeing you at future Vertex webinars. So enjoy the rest of your day, everyone. Thank you.